Fantastic. Welcome, everyone. It's just about not January anymore. So it's just about not Happy New Year anymore. Yesterday, somebody still said Happy New Year to me. This is the first session that is as public as the quote unquote insight sessions that we're hosting at VentureESG this year. And as usual, we're taking on one of the bigger conversations that we think are important to have. Today, we're very, very lucky to have four fantastic speakers from a variety of different backgrounds, all of whom you'll hear from across the next hour or so. I'll start from the back, so to speak. Kat joining us from Paris, I imagine, in a sense representing the company side, but at the moment also very much representing the policy and politics side, as you've worked at Content Square for a long time and then are now working for the European Commission. I'm looking forward to hearing from you. Matthew Joseph, Kinnevik, one of the most outspoken and most committed investors when it comes to the kind of growth equity, startup investment ecosystem, and ESG responsible innovation. Very, very good to have you here to represent the VC side, and Peter Dunbar, whom I'm sure some of you know with his different hat from his time at the UNPRI, now representing the LP side as a principal at StepStone. And as I said, I started from the back because we're ending and beginning with Anikka Villegas from Pitchbook, who's the report author of a piece that came out last year already. This webinar has been in the making for a while on the underperforming ESG managers in the private markets. We're going to hear from you first, Anikka, and then we're going to have about 20-25 minutes of conversation among the panelists and plenty of time, I hope, for Q&A. We're going to keep this as conversational as possible. So everyone who's listening in, please do jump in at any one point. I will take the liberty of disrupting anyone with your questions, audience members, throughout. This is not staged, and hopefully we'll all take a lot of insights away from today, which is exactly the point. So welcome, everyone. Thanks a lot for joining, my dear panelists, and kicking off with Anikka and a kind of quick 5 to 10 minute overview of what that means, the underperforming ESG manager, specifically as well, which I'm sure you'll tell us about, wasn't covered in the report for the venture capital ecosystem.
Great. Yeah, I really appreciate that introduction. I think, Danica, you were going to share some slides for us.
I've actually just made you a host, so you should be able to share right now.
Okay, let me get on that. Okay. All right. Are you guys seeing my screen?
Yes, perfect.
And then I'll go in presentation mode. I have to do a quick switch here. All right. Now you guys should be seeing it in presentation mode. Is that right?
Yep, we can see that now.
Perfect. Okay. Well, let's get started. So, yeah, to help kind of lay the groundwork for our discussion today, I'm going to be sharing some of the analysis from a piece of research that we published last year called Are ESG Investors Underperforming? And this was a collaborative effort between myself and a few members of our quantitative research team, stemming from the desire to get some data around the question of how ESG commitments affect private market fund performance. As I'm sure you're all aware, there has been really intense debate occurring over the past few years around ESG and the question of how it influences returns. That question has largely remained unanswered, especially with respect to the private markets, where it is very difficult to collect and verify data on GPs' ESG strategies and ESG performance. So there are two main theories of how ESG impacts financial returns. Theory one is that ESG improves long-term investment performance by mitigating material risks, which typically manifest over a longer time horizon. These may be employee retention risks resulting in increased voluntary employee turnover, or data privacy and security risks resulting in litigation or fines, or other ESG-related risks and impacts. And this risk mitigation also theoretically makes companies more resilient by protecting against downside risk, which is beneficial during market volatility and when black swan events like the COVID-19 pandemic occur. It can also result in a lower cost of capital, which can have a positive impact on returns as well. But theory two is that ESG harms performance because it can involve placing artificial constraints on a portfolio, including limits on the business models and the industries in which investment can occur, and can create obligations around spending on operational improvements that might not otherwise have occurred and are harmful to the bottom line, at least in the short term. Now, some have cited the recent outperformance of private oil and gas funds as one example of this, with investors that have foregone investment in that sector missing out on those returns. But in VC, there are additional layers to these theories. So for the first theory, some will argue that building in sustainability considerations from the inception of the company can help prevent significantly more difficult retrofitting in the future. For example, establishing a diverse and inclusive workforce from the beginning is much easier than attempting to make a homogeneous employee base diverse later on down the road. And similarly, technologies developed with sustainability in mind are less likely to need to be modified to comply with new climate-related or environmental regulations. Or to use a recent real-world example, establishing strong governance practices like creating a robust board of directors early on is far less difficult than attempting to work backwards to unwind a web of serious governance issues, as we saw with FTX. But to the second theory, some VCs and startups will also argue that early stage companies need to focus first and foremost on the path to achieving profitability, with ESG considerations and the resources that are necessary to mitigate those risks, holding companies back from the explosive growth that is necessary to do so. Go on to the next slide. Okay. So we attempted to bridge that gap. We combined publicly available data from the Principles for Responsible Investment, or PRI signatory database, with our private fund performance data. And if any of you are unfamiliar, signatories to the PRI make a commitment to incorporate ESG issues into their investment analysis, decision-making, and ownership practices. It is important to mention that many GPs have an ESG program or strategy, but are not PRI signatories, and that not every PRI signatory is going to have an ESG program of equal caliber or maturity. So there is considerable variability within the data set. In addition, we know that not all PRI signatory funds engage in the activities considered typical or necessary to qualify as ESG aligned by various individuals or groups, hence the inclusion of the quotes around ESG investors in the title of the piece. Instead, this data just captures the performance of funds after their fund manager made a public commitment to PRI and to ESG. And despite its limitations, it is one of the most, if not the most, current and comprehensive publicly available data sets pertaining to if and when an asset manager has made ESG commitments. To take a closer look at the data set, as Johannes mentioned, we did exclude VC from the analysis because the sample size of the PRI signatory VC funds with performance data was just 13 vehicles. So our analysis encompasses private capital, excluding VC, which is PE, real estate, real assets, and private debt funds. And while this research was initially published in 2023 with data through Q3 2022, we were able to update it through Q2 2023 for discussion today, which is our most recently available fund performance data, given that there's a reporting lag that exists for private funds. So for our methodology, we used PRI signatory status as a positive indicator of a commitment to ESG and compared a data set of funds raised by GPs after they became signatories with one of funds raised by non-signatories. And that includes not only asset managers that have never become signatories, but also those that later became signatories but had not at the time the fund was closed. So we evaluated IRR and total value to paid-in dispersion between the two groups relative to each fund's respective benchmark, which is defined as the median return of the vintage year and the asset class. And we focused on the vintages 2010 to 2018 with more recent funds excluded from the analysis because performance metrics for younger funds are frequently not meaningful. So for our findings and conclusion, on this slide, and then on the following ones too, the chart on the left has return dispersion for signatories, which are on the right, and then non-signatories, which are on the left. For the overall private capital universe, we see slight underperformance from PRI signatories in terms of median returns, with less dispersion overall, and then a narrower top and bottom quartile range with a lower top decile and higher bottom decile returns. Now, the results for the graph on the left do not control for geography or fund size. And based on previous research, we know that larger PE funds tend to outperform, and that North American and European funds have different risk return characteristics than those in the rest of the world, which likely skewed results. We also wanted to control for the fact that a bias might have existed in the results due to the quality of PRI signatory asset managers compared to the non-signatory managers, rather than PRI signatory status. So it was necessary to isolate for that factor as well. To reconcile these issues, we ran linear and logistic regressions, allowing us to compare performance differences more directly across signatory status and to control for additional factors that could have affected performance. The results of those regressions are in the table on the right. And for the overall private capital universe, the p-values were not statistically significant, meaning there was no evidence that PRI signatories performed differently from non-signatories in a statistically meaningful way. Zeroing in on private equity, things look pretty similar to the overall private capital universe. There is slight underperformance by median return rather for PRI signatories, but significantly less dispersion. But again, looking to the regression analysis results, there was no statistically significant difference in performance. We also did this analysis across each of the rest of the asset classes, all with the same findings, except for one asset class. And that was real estate. So on the graph on the left, you can see that the median return is only marginally higher for signatories, but the top decile and top quartile returns are far above those of non-signatories. The recently updated data yielded a new finding that differed from our previous report. For real estate vehicles, both linear and logistic regressions resulted in statistically significant p-values with positive coefficients, indicating that real estate vehicles raised by asset managers after they became PRI signatories outperform compared to those raised by non-signatories. And this is, of course, a really interesting outcome. And we can theorize about why it is, perhaps in part because real estate funds that focus on sustainability suffered less from the impacts of the European energy crisis, but it's not terribly relevant to VC. So I do not want to spend too much time on that portion today. It also is important to note that these findings do not provide the definitive answer to the question of how various ESG-related strategies influence investment returns, although they do bring us one step closer. And to bring our focus back to VC, this research provides some foundation for the idea that ESG does not necessitate sacrificing returns, at least in the overall private capital universe. Of course, venture has its own idiosyncrasies, so the analysis is not going to translate perfectly, but the data that we do have works against the assumption that a portion of the investment community holds that ESG harms performance and could even constitute a breach of fiduciary duty. There is so much more to explore here, both in research and in conversation, including with respect to the payoff that pursuit of ESG-related opportunities like those in carbon tech, ag tech, and mobility tech have for VC investors, and more topics to cover today. So with that, I'll hand it off to Johannes to begin the panel portion of our time today.
Perfect. Thank you so much for giving us this background, Anikka. One quick question to all the other panelists before we're jumping into some examples and dragging this even more directly into the VC and startup ecosystem. There's one assumption built in here which I would like to challenge, which is being a PRI signatory, and I'm looking at you, Matthew, already, is actually a good indication of meaningful ESG integration in the private markets, and especially for venture capital. what are we making of this? And we can take you out of this, Peter, if you want. But Matthew and I have discussed this, and I lean in one direction, and yeah, perhaps Matthew, if you wanted to jump in.
Hi, thanks for having me. And for those who may or may not know, I lead Kinnevik's sustainability function. And Johannes, to your point, we are actually not PRI signatories because we felt that the framework that the PRI had did not suit our business model as venture capital investors. And I think we've had a few conversations with Peter in his previous role, and I think we've even evaluated it a third time at Kinnevik and concluded again that we felt that the model or the ratings that they had were not right for Kinnevik. With that said, we have, I think, been extremely committed to ESG because I believe, and Kinnevik believes, that this is the only way we can build long-term sustainable businesses. And I think, Anikka, to your conclusion on, I think the first point that you had focuses on downside protection, but we've also strongly believe that the other side to that is the opportunity piece, which hopefully we can talk to during the course of this session.
Yeah, Kat, perhaps jumping in with either of these directions. Let's talk a little bit about from the VC, LP, and Kat, for you perhaps, company perspective on, are there examples from your realities that show quite clearly that there is something about ESG integration in a meaningful way in our ecosystem that actually shows more or less measurable? And I think that there's another assumption here that you can quite quickly, in a kind of 2010 to 2018 timescale, measure these returns, but in a more or less measurable way, there's benefits to doing ESG. Kat, do you want to start us off? And then perhaps, Peter, you can jump in from an LP perspective, and Matthew, you can give us a little bit of flavor from your venture capital perspective.
Sure. So, just sort of maybe speaking as my own experience as an operator in a late stage company, the big chunk I think that's missing for me, that was a large part of my reality, was neither covered in theory 1 or theory 2. And that may be related to the scope that we're looking at, which is 2010 to 2018, which are market forces. And those market forces were probably not as strong at the time. And one of the strongest by far market forces is anything related to talent. I can tell you that every time we would run employee surveys, the year that I joined as Chief Impact Officer, over, I think, 50%, if I'm not mistaken, but certainly like the largest chunk of people said that they joined Content Square. One of the reasons why they were pushed to join Content Square was because of our ESG commitment. It was certainly a big part of it. It's actually interesting to look at those variations are across teams and across geographies. So Content Square is spread out across 15 different geographies, not counting, of course, the part of the teams that are fully remote. And you're still seeing different variations. So, for example, in the US, the immediate questions, especially at the executive level, will be on our D&I policies. And in France and in Germany, and I think like a large chunk of Western Europe in general, especially in the product and the tech teams, you have very, very, very precise questions on our sustainability policies. So I think that's something that, feels, I would say, relatively recent to me, with maybe some things peaking over around the time of COVID. And then you also have, so again, this is part of my reality since at the time, because Content Square is an enterprise company. You're also looking at some of the conditions around procurement that were probably not as big a deal at the time. And I can tell you some of them are very like tokenistic. Of course, it's like, do you have an ESG policy? If yes, check the box and like add something and, attach something. But then some of them are very thorough. Microsoft, for example, will drill down to details when it comes to the level of accessibility of your product. And again, depending on who you're doing business with, especially let's say if you let's say whatever in the space of GovTech and doing anything with government, that becomes particularly important. And then, of course, this is something I guess that has been more obvious, which is really just the general push from the consumer side.
Fantastic. Yeah, and I think your reflections from a company perspective here are very clearly also shown in research. BDC, the Canadian public LP, has published an enormously big study on how in a B2B context, this procurement angle basically forces you to do certain ESG bets as you're scaling your company. This is not a seed stage company issue, but this is a bigger company stage issue where you can't do business with certain corporates, right? And I think this is going to become more of an issue. Peter, perhaps you jumping in?
Yeah, thanks, Johannes. Maybe look, I'd quite like to just come back around to the topic of kind of PRI and the Pitchbook paper as well. But just kind of before I do, I always try to sort of start off just making sure we're all on the same page in understanding what we're talking about when we kind of talking about ESG and what we're not, because I think that kind of, you know, depending on your understanding of what it is we're actually talking about can sway the conversation quite a bit. So, you know, for us, we don't see ESG as, you know, thematic investing. So, you know, it's not about investing in the decarbonization trends, etc. It's not about having a narrow focus on DEI. It's not impact investing. And, you know, it's not about investing in a company that's an ESG company or kind of one of the bits of terminology Anikka was using, I think, in the report was, you know, ESG funds. I don't think I've seen a private equity fund marketed as an ESG fund, to be honest. It's generally, you know, we're thinking about a process that's integrated within an investment process as opposed to kind of a distinct product. So that's how we kind of think about it. And that process is really just trying to minimize the risks that kind of some of the ESG factors can bring about, maximize the positive outcomes as well. And the two things combined, you know, okay, the evidence is a little challenging to come by, but we believe that those two things combined and integrating these things leads to better businesses being built, better products, etc., and right from the start as well in the case of VC. So you're not trying to kind of reorient an oil tanker once it's kind of, you know, a large company. You know, we're talking about the business case. I think, and there's clearly a lot of stuff out there and a lot of evidence as to why and what can happen when investors, companies don't integrate ESG. They don't think about ESG factors. Like there's some of the really kind of like hackneyed examples out there, like we use a lot of the time, but I think we can learn from those. So thinking about governance failures, let's not forget governance is part of ESG. FTX, WeWork, all the rest of those that we all know about, but they're probably the tip of the iceberg, right? They're the ones we all hear about, hits the press, etc. There's probably 100 kind of businesses that suffer from poor governance and poor kind of outcomes as a result beneath those. Environmental factors, we don't necessarily in VC kind of, you know, outside of, you know, climate tech and that thematic side of investing, we don't necessarily see, you know, companies as high emitters, but, you know, if you're a growing software company, yes, it is important that you start thinking about your carbon footprint, or at least kind of understanding what it is, calculating it. You know, if your exit route is to an MNC that has their own kind of targets, Microsoft or whoever, they're probably going to want you to understand those things about the business. And, you know, so you know, from a kind of exit point of view, so you may as well kind of get these things built into the business and understood early on and kind of future-proof the business. And I think it was Kat talking about kind of employee retention, attraction as well. I think kind of focusing on some of these E things and S factors can certainly do that, and that has been really important when there's been, you know, quite a war on talent, and that's really important to fast-growing companies. We've seen a lot of kind of, you know, fairly nasty examples of sexual harassment in GPs, in portfolio companies, startups, etc. So again, you know, focusing on the things that mitigate the risks around that is like, clearly important. But anyway, coming to one of the points I was thinking about beforehand is that trying to evidence this is really difficult. And I think it's the problem is this thing called the prevention paradox. So you're basically, the effectiveness of preventing something is kind of invisible, right? So the benefits that you derive from it are unobservable, unquantifiable. And I think that can just really lead to an underappreciation of the importance. So we can look back at some of these FTX type things and the big blow-ups, but it's quite hard to quantify where you have kind of led to something not happening. So that kind of leads back to the Pitchbook study in a way. And you think kind of, maybe isolating two different populations of GP or funds, you might be able to kind of do that to an extent. But the thing, I think Anikka kind of explained really some of the fundamental issues with that study, right? The PRI, and this isn't like trade secret PRI, internal PRI thing. Its mission is, as a broad tent, is purposefully kind of inclusive of funds that are really at the beginning of their ESG journeys, etc. So just being a signatory doesn't confer anything about how well implemented ESG practice is at a GP. Now, the score maybe, right? But and when we assess a GP, so every GP we invest in, whether it's VC, real estate, whoever, private equity, we undertake pre-investment due diligence to just really try to understand how well they manage ESG factors. And a whole bunch of things kind of goes into a scoring rubric. And the difference actually being a PRI signatory makes there is about, I think it's like out of 4, so the scale goes from 1 to 4. Out of that, I think it's about 0.2, 0.25. So there's a whole bunch of other things which can't be captured by just being a PRI signatory or not. So, and actually I thought the conclusion was interesting, or the question around like ESG managers underperforming. To me as well, if there's no statistical significance between being a PRI signatory or not in terms of returns, you could also just say, brilliant, that you can be a responsible investor and not sacrifice returns. Excellent, right? So there are different angles, I think, to sort of take from the study as well.
Yeah, I think we're coming back to that, and I do believe, whether this is by design or not, that has to do with the kind of overall narrative shiftings that are happening. But briefly handing over to Matthew for a second, take us to the VC. Why does this matter?
So, Kinnevik is a long-term investor, and I think for a long time, I've been doing this for about 8 or 9 years. We were trying to have this narrative that Peter was trying to articulate, saying that, listen, it's extremely valuable because no news is good news. And, it's extremely hard for us to put down a number of dollars being saved because something didn't happen at a company. What I felt was that narrative didn't fly with the investment team in our funds, and they really wanted to have concrete examples. So we did 2 things. One was, I think this was back in 21, at the peak of the boom of the market, right? Where we're kind of trying to do a correlation between the ESG score and the valuation uptick of our companies, and for some magical reason, it did correlate, given we had a lot of uptick in our US healthcare valuations, which were normally had good ESG practices. So I was about to put a paper out there, and then the investment lead came to me and said, listen, Matthew, it's very hard to specify whether it's ESG or the market that's driving this. So we kind of did not publish the paper. But what I think has happened since is we've been trying to focus on specific examples, right? And now we've built a bunch of case studies. Happy to share them here. I actually, when Johannes sent this out, I thought it'd be good to give a specific one on ESG, very quickly, spending a few seconds on each. So we have one company, Oda, which really focused on driving and reducing their carbon emissions, and it's an online grocery business. Sorry, I should have said that before. And they were nudging customers to also reduce their carbon emissions. And what that did was they won a contract in Norway worth, I think it was 50 million kroner, which is roughly $5 million, because the Norwegian state started including ESG as part of their procurement criteria. And now more and more of these government procurement departments are including that. On S, everybody knows everything about attracting talent, but I thought I'd give another angle for one of our healthcare businesses in the US that is in the mental health space, where we broaden the diversity of S into the providers, i.e. suppliers or contractors. And what that did was better matching of patients to their counselors, which again was a revelation. And we actually saw an uptick in the patient satisfaction as well as the provider satisfaction, because the toughest thing in the US is to actually retain providers because they churn out pretty quickly. So that was positive on the S. And on the G side, again, in the US, we recently had a company called Betterment, which got a notice from the SEC on requiring a bunch of audit issues. And I was struggling to actually produce a G case for our investment team. And they really presented all of the developments that they did across G, risk management, compliance, and all of those things, and presented it to the SEC that waived the request. Now, that saved them $1 million in fees, but much more in terms of when you have an auditor, they are forced to justify their work and then put up, optional recommendations. And then the process to get that out is a long and tedious process for the business. So we do have a bunch of other cases. If you go to our reports, you would see specific ones on our companies. Sorry, that took a few more minutes, but
no, but I think that's what we need. And Anikka, back to you. Now that everyone said, no, this is wrong, we believe very strongly there is a case here, or there's many, as Matthew just concluded. Is a kind of secondary conclusion not only Peter's avenue of, oh, you could have also said ESG might not immediately lead to better returns, but at least it doesn't lead to lower returns, or not at least significantly so. Are we missing the data to really show anything? And partly, if you would have asked me, can we run a quantitative analysis here? I would have said, on what data at all? We haven't collected anything that is meaningful, or we're only now seeing, and this is also unfortunately not VC data, the data convergence initiative producing the first results, and they're working with BCG on that. And the first pieces of research have come out showing, fortunately, for the work that I do, positive correlation. So is this a data issue? If so, what are we waiting for, looking for? What are promising avenues to do something similar this year or next year or in 3 years? Perhaps Anikka, if you wanted to jump in here.
Yeah, definitely. I think all of those points were great points. I would reinforce, this piece of research was created due to the need to put some data to this huge question that everyone was asking. By no means is it perfect, and I think all of those critiques certainly have some validity. And you're totally right. We don't have good data right now, and we need it, at least to prove the business case for ESG and VC as a whole. And there are a few challenges. I think the first is defining what an ESG investor is. There are many different approaches to ESG, and no one single agreed upon criteria or performance standard for establishing a threshold at which an investor would qualify as an ESG investor. And second, even if there were convergence there, we would need comprehensive and publicly available ESG performance data to compare private fund performance against. And that data is difficult to collect and very difficult to get GPs to disclose. particularly if it offers somewhat of an unflattering portrayal. I think with regulations like SFDR, we're inching our way towards these outcomes, but the progress is really slow. So in the meantime, we do have to work with what's available. I concur. I think that there is some substantiation out there for mitigation of individual risks using kind of back of the envelope cost benefit analysis too. If you're a food product manufacturer and your product has to be recalled because it's causing illness among consumers, that's going to harm the bottom line. And there are models to calculate how much a food product recall could cost. So there are ways to make a case currently for some ESG improvements. It's just difficult to make that quantitative case for ESG as a whole in VC right now.
Pat, jump in.
Yeah, I was just thinking, I think something that, I mean, I don't know, it's very difficult to do anything quantitative when you can't compare apples to apples, right? But I think maybe something that would be worth looking into is that, with the waves of layoffs in tech over the past, two or more years now, there are some companies in which those ESG teams are very strongly hit or completely wiped out. And there are others where they are not, So speaking for the case of Content Square, we pulled back on philanthropy and we pulled back on all of the sort of investing in the impact capacities of the product. But the ESG side, and which I will define as sort of like basic moral hygiene, I guess, for 2024, was not touched at all. In fact, it was reinforced because it was very much aligned with, say, sustainable policies, aligned very nicely with, cost cutting and things like that. Anyway, I mean, it would be more quantitative, but I would be so curious to see what the long-term or even short, medium, whatever impact of having pulled out an entire ESG team or initiative or commitment from a company would be, as opposed to those who maintained it in the in the middle of a downturn.
Yeah, and that actually feeds very nicely. I want to throw this at all of you. The lengthy description from Jeff, which actually ends in what I think is a brilliant question. Why would a portfolio company / a VC firm forcing or encouraging their portfolio companies not want to do ESG? Given what we've just all discussed, what are you hearing, for instance, Matthew, from your experience, or also Peter? And is this then a question of education? They don't quite know what ESG is, and you need to spend a lot of time doing this work.
I think unfortunately, I mean, this is the acronym ESG is being attacked especially across the pond. I mean, I've had a few conversations with thought leaders from the US, and I feel the fundamental issue on both sides of the debate, as I think Peter alluded to, is actually defining what ESG is, right? And I mean, as an independent, yes, I am biased, but I'm trying to wear an independent hat, looking at the debate across the pond, and I feel that both parties are talking about exactly the same thing. As long as you remain relevant, strategic, and operational, I think both parties agree that it's important for the business. So be it, if you're a software business and someone's forcing you to, focus on E instead of S, then clearly that's value destroying, because you could do all the good things in the E pillar, but actually where you make a difference is in the S and potentially the G. So I feel that as long as, when I have these conversations with our companies, my approach has been trying to be bespoke to the business model, stage, size of the business, as well as the founder and the management team. I try to choose my words correctly, and if we can position this the right way, I've not felt any pushback. The moment we go into, hey, we as Kinnevik want you to do this or that, that's when you see the reactions, the negative reactions. And we've definitely done that in the past 4 or 5 years ago with both DEI as well as E, setting targets, etc. So I feel to respond to you, Johannes, education, yes, but also being a little bit self-conscious as you drive these conversations to get to the desired outcome, because I think ultimately everybody wants to create a long-term sustainable, profitable business.
Yeah, I mean, I have similar views, really. I think some of it is certainly driven by misunderstanding as to what it is and what it isn't. That's been obviously really ramped up by the politicization. I'm not sure I nearly got that out. Politicization of it. And kind of going back to what I said at the beginning, you know, it's ESG. If we're talking about ESG integration, it's a process. You know, you're focusing on things that have material or could have material, you know, kind of financial benefits in doing these things. It isn't something that should be political. It's dealing in some topics which obviously get quite political, like climate, like DEI. But you know, the reason investors are doing it on the whole, if we're strictly talking about ESG integration, is to, you know, try to build better businesses, try to make better financial returns. And, you know, in many cases, the great kind of side effect of that is more positive outcomes as well. Yeah, definitely misunderstanding. And, you know, I think we've moved along quite a bit in the last few years, Johannes, as well. I mean, a lot of hard work by people like VentureESG as well, as in terms of kind of trying to get people to focus on materiality, trying to kind of get what I would really like to see more, not just in VC, but in PE as well, is people doing like the hands-on kind of engagement work that you know, Matthew's doing. That real kind of rolling up sleeve type stuff, as opposed to you know, data is important. You know, in certain situations, of course it is, but it's not the be all and end all, and it isn't kind of ESG in and of itself. So kind of more of that sort of stewardship engagement side of things, value creation work's needed, I think.
And perhaps that is also a way for us to counteract the very strongly American politicization of this conversation. Let's do the work, so to speak. And we've talked about this many times in a variety of different outlets, but in the end, as soon as you go to the level underneath E, S, and G, and to a certain extent, the E, S, and G is underneath the level of responsible technology, responsible investing, that's even a little bit more vague, which some, both LPs and VCs go to. But if you're then focusing on the G and good governance, everyone is just nodding, oh, obviously, yeah, we care about good governance. Good governance is good for business, despite some FT commentators' claims recently. So what are we going to do about this depoliticization of the conversation? Or are we just in a sense going to ignore it, let the politicians talk about it, and do the work, both on the investor side, on the startup side, on the LP side, and I mean, collect the data as we find it, for you guys at Pitchbook, for instance, perhaps starting with Kat, given this is the politics question.
I mean, one lesson I think I learned the hard way at Content Square around this topic is that whatever it is, it can't be solved at a global scale. And I think that was, you know, probably one of my earlier mistakes as a chief impact officer, which is, you see, it's very clearly political, but it's political in very diverse ways around very different topics with different nuances, with different sort of team compositions. And, you know, if you're talking, and I think, like, you know, those conversations are very healthy, but, you know, if there are any founders listening on this, whatever you do, don't do it immediately at a global level, because that is like a surefire way to, you know, trigger a bunch of firecrackers. And maybe, like, just, you know, sort of reflecting on that, and maybe to add some nuance as well to your previous question on, you know, why wouldn't you pursue ESG? I think as an operator, one very obvious answer to that is that it's really hard. right? It's like really hard. It's like, it's not like, oh, we're going to do ESG and then all of a sudden, poof, you know, it's really, really hard. And I think it gets harder at the late stage. So I think the question is also, you know, whether or not it makes sense as a long-term investment. And I think that's true for later stage companies that are pursuing an IPO. That's true for companies that dream of being 100 and 200-year companies. That is not true, you know, of companies that have sort of lined themselves up for a sort of easy acquisition in a couple of years and just kind of want to, you know, jump ship or whatever, like founders who want to bail the next secondaries or things like that. So I think there's quite a bit of that as well. And I think that another thing that we tend not to really look into is the operational cost of ESG. It's a lot of cross-functional operations, and many companies are just really bad at that, you know, for a very long time. And so for, you know, for the companies that I've worked with, we've sort of just snuck it in as a Trojan horse around the pre-IPO readiness work streams, which have really like helped accelerate so many things that, you know, nobody would take the time to do a meeting for if it was going standalone. So I think that, you know, a lot of people think it's like ESG is a no-brainer. I feel like maybe ethically it's a no-brainer. Operationally, there are a lot of really important questions that, you know, founders and their investors need to answer before they really move forward.
I would just add to that we also try not to have that as a separate item, and we just include every work stream into the respective functional heads, right? So if you're talking about DEI, we get the people team to drive some of those initiatives. If it's I think with the exception of carbon footprinting, where it's relevant, then we obviously have a budget, but we try as much as possible in our companies to not have a separate cost center or anything associated, because that's, again, one, I think to your point, Kat, will get cut fairly quickly if I had my CFO hat on in my previous life.
But isn't it all as well just about kind of, you know, disassembling all the constituent parts of ESG, you know, so, you know, we kind of keep saying doing ESG. I mean, that's not really, you know, like I would argue that, you know, under the G and the S, every company, you know, even at a pretty early stage, should have a code of ethics, for example. And yeah, you kind of that comes at a fairly low cost, I would say. And can protect against some, you know, quite a few issues. But do you want to do scenario analysis on kind of, you know, your physical climate risk? No, but it all falls under ESG. So I think we need to just start kind of splitting it down to its constituent parts. And I think that also comes to the evidence as well. I think we're on a bit of a fool's errand, personally, to try to, you know, prove that ESG is, you know, at a kind of asset class level, value creative or not. I think it's going to be incredibly difficult. I mean, clearly, you know, StepStone has a great deal of data, and, you know, maybe at some point we could try to do something like that. But I think, you know, there's a lot of academic evidence around, you know, certain aspects, again, of ESG, like DEI, and it's also really complicated. It's not as simple. If you kind of like look at Alex Edmonds' work on DEI, you know, he found no real evidence that that diversity, especially at board level, was actually directly related to company performance, the stock returns. But DEI performance, so like as soon as you start including the E and the I, was. But that E and I is like really hard to measure, and it's difficult. What do you do? Do you look at like Glassdoor scores and, you know, all this kind of thing, possibly? So I think we need to kind of burrow into the kind of individual things that investors, companies are doing, and try to think of it that way. Also, like, I'm also in two minds in a way, because, you know, a lot of other things that private equity investors do don't kind of, that there isn't this kind of discussion around, with such a high bar around academic evidence overdoing it. I mean, I'm just kind of thinking off the top of my head, but, you know, a buyout firm kind of, post-investment, quite often they'll replace members of the C-suite. So CFO, COO, whoever. I mean, Johannes will probably prove me wrong, but I don't think there's kind of any academic evidence around whether that's the right thing to do or not, for example. So are we, kind of holding what we're doing up to a much, much higher standard of evidence?
I think that's a very, very fair point, Peter. And I'd like to take your kind of future vision and let everyone give a similar type of outlook. From your point of view, Anikka on the data, Matthew on the VC operational work, Kat, pick your poison, company policy, Peter from an LP perspective. What's going to happen? What you think should happen when it comes to what we discussed today, this doing the work of ESG in the startup ecosystem? What are we all responsible for? Where do we need to do more work, perhaps? And what kind of work should that look like? Thinking about the next steps for all of us to take. And perhaps building into that, the question that Paula had here as well. What are you already seeing happening, right? This question was targeting you, Peter, directly. Are LPs thinking about this more? Is this going to become more of a thing, Kat, from a policy perspective? To a certain extent, that's the most transparent. We know, yes, absolutely, there's more acronyms coming towards us, and especially to the company level, that are all in the widest respect about ESG and the kind of, as you called it, the constituent parts, human rights being one of them that's on the agenda. Perhaps everyone take a minute or two, but not three. That would be overtaking it, to end with your reflections. Jump in.
I'm happy to start. I mean, I think on the terminology question, I don't think the term ESG is inherently flawed. I think that it effectively captures a breadth of pretty complex, nuanced, interconnected issues that pertain to social, environmental, and business sustainability. But unfortunately, I do think that a shift in terminology might be in our future. Here in the US, we've had a state bill proposed that would make ESG investing by state and pension fund officials a felony. And while it was rejected, I do think that proposal shows just how politicized the term is. So it may end up being a time where we start over with a new term in service of ensuring that asset managers don't have to choose between the ability to fundraise and ESG practices. And then in terms of, next steps for the VC industry, I'll keep it short. I think from my perspective, the next few steps are continuing to work towards convergence on terminology and metrics for measurement, and relatedly continued ESG data collection. We can have more sophisticated conversations about what's working and what isn't working in ESG once we're using the same language to discuss them and can quantify what strong performance looks like from an ESG perspective, especially with industry level benchmarking. Both of those things are certainly more easily said than done, and have been works in progress for quite some time, but we're not at the finish line with either. So I think there's more work to be done there.
I can go next in terms of the VC industry, at least the way I see it. There are two areas. One is I think founders and management teams are now hearing more about it. And the trick for me personally and Kinnevik is to actually remain strategic and bespoke and operational. So as I look to the next years, if we really want to stay ahead of the game, it's to, despite everything else, acronyms and regulations coming, our way to try and keep the founders on point by remaining strategic, bespoke to the company. And finally, I think the other side is regulation. I think everybody has been pushing back. It's no longer an option. You're going to have SFDR for us, but you're going to get CSRD and tons of other regulations that kick in and force companies down a certain path. But what I'm trying to do is to get founders and management teams' minds in the right place instead of regulation getting them in that place. I think the outcomes in the two approaches would be significantly different.
Way to go, Johannes. I think, look, I know the policy is just like, it's not the be all. Well, clearly not every policy is made equal, and often they're not implemented well necessarily. But I think it's a bit of a kind of hygiene factor to at least have a policy, define, lines of accountability, bring a bit of transparency around exactly, how an investor is integrating this within their business. So we've only got around 56% of 145 odd VC GPs that responded to, sorry, not responded, no, that we got through pre-investment due diligence, have a policy which compares, I think it's like up in the 97s, 98% for kind of all the other private markets asset classes. So some of just the building blocks to more, getting a policy in place. We've been helping some VCs that we've invested in, improve those or have one. Sometimes we kind of push for them to have one post close, within a certain time frame. But that's just the beginning. I think, going back to a lot of what Matthew said, sorry, and I'll try not to do the 3-minute thing, a more thoughtful approach, really, more engagement with companies. We see a lot of things, GPs doing things like conscious scaling, red teaming, and, trying to be a little bit more strategic about what they're doing and doing it, integrating it in more depth. Yeah.
So I think for a lot of people that own a lot of ESG transformation of certain companies, I think it boils down to two ways of looking at it. Either you think that the people in your team are fundamentally bad, at which point then you need to create a whole host of incentives, everything from like annexing their bonus to it and so on, in order to achieve the ESG results that you need, at which point, you could have a sort of like big bad VC kind of like swoop in and like impose these policies, help encourage imposing these policies top down. Or you could believe that people are fundamentally good, and there are a host of all other reasons to which this isn't happening, most of which is capacity, understanding, awareness, and so on. At which point, the way that you would sort of grow and nurture ESG in your portfolio company would really start with capacity building very, very early on. And I think that, there's some standard practices that should just be the same across the board. And, there are three that I feel very strongly about that, may seem very basic, but are actually quite absent from a lot of funds. And one of them is to really integrate ESG KPIs as North Star KPIs in board reporting. Super simple, but it just forces people to have this conversation, forces the exec teams to have the conversation when everybody's prepping. And, if you're doing it every quarter, at some point we're like, why is this number still like this? I think another one is also for pre-seed and seed companies. So much of this is really, the pressure goes on to the founding teams, specifically the CEO. So it's really kind of like working with them very early on, because they're not going to have specialized teams for quite a while. And I really believe that once a company gets to a certain scale, it's not just a matter of size, it's a matter of complexity, whether it's like number of geos, for example, like number of geographies that you're present. Like, let's say if you're dealing with a topic as like DEI, the way you're going to deal with it, if you have a team in Israel, you have a team in the US, and you have a team in the UK, are totally different. And that's something that's very, very difficult to do when you're just, inside HR. If you're dealing with a lot of DI is also a really interesting one, because people think it's just, a matter of like being kinder. But, let's say that you were actually going to push to increase the number of product managers at a leadership level, senior leadership level, that are women, and you're willing to wait, then therefore spend more time doing it, then you have, an impact on the product roadmap, then you have an impact on quota for sales, and so on and so forth. And so I genuinely believe, and I've seen this firsthand, that once you get to that level of complexity, you do need a team, essentially, and you do need a separate cost center, because the chances that those budgets will get cut are actually much higher if they are directly in, a product and in HR and so on. But most founders will not want to do this, because they'll be slightly like ashamed to explain this to their VCs, especially when they're fundraising. And so I think one other thing to normalize is that this has to be like a normalized cost beyond, Series A and so on. And I think that culture shift will also have to come from the VCs themselves.
We've seen that cost being pushed up, or people have been trying to push that cost up to the LPs as well. This was a fantastic round of conclusions. Looking forward, I think I would conclude that among all of us, despite data being scarce and pointing in a direction that isn't exactly what ideally one would like to see, which is a very clear correlation of all the quantitative data that we have, which unfortunately we simply don't, between ESG, meaningful ESG integration in venture capital returns. We all can agree, and we use words like conviction, which are very normal in the VC ecosystem. As you know, that's what everyone just has to build in order to invest as well. That ESG, which is not a sector focus, but a process, does make financial sense. There is a business case for it. If you look at ESG as a risk issue, governance failures have been all around us. Some of this could have potentially been prevented, even though there's a whole paradox around this prevention bit. There's enormous amount of ESG opportunities. The easiest one, perhaps, and the most best researched around diversity, but it's also become a license to operate. Think about your carbon accounting as one way of doing business, B2B, now already, but going forward even more so. I think what we're missing perhaps in something like a data analysis, running a correlation, is ESG has to be specific. It has to be localized. You can't do it everywhere the same. It has to be dissected into its constituent parts, and it has to be bespoke, ultimately also distributed across different functions, different teams. It's ultimately a full body workout. We'll see whether we at all and ever can get away with the tension between what quantitative data can capture, and this is complex, we always say, and what we know doing this on a day-to-day basis. Thank you so much, especially the panelists, but also everyone in the audience. To be continued.
Thank you. Bye-bye.
Thanks, everyone.